Welcome back to our channel, The Investment Insider. Today, we have an exciting topic to delve into: systematic investment plans, commonly known as SIPs. If you've ever wondered how SIPs work, how returns are generated, and how SIPs compare to lump sum investments, you're in the right place. So, let's jump right in. Part 1. What is an SIP? To kick things off, let's break down the basics. What exactly is an SIP? An SIP is a method of investing in mutual funds where an investor contributes a fixed amount at regular intervals, typically monthly. This approach is particularly appealing for those who want to invest but may not have a lump sum amount readily available. A systematic investment plan, SIP, is a method of investing in mutual funds that offers a structured and disciplined approach to building wealth over time. In an SIP, an individual invests a fixed amount of money at regular intervals, typically monthly or quarterly, into a chosen mutual fund scheme. This investment approach is designed to make investing more accessible and manageable, particularly for those who may not have a large lump sum amount to invest upfront. The key advantage of an SIP lies in its ability to harness the power of compounding and mitigate the impact of market volatility through a technique called rupee cost averaging. This means that as the market fluctuates, the investor buys more units when prices are low and fewer units when prices are high, ultimately potentially reducing the average cost of their investment. SIPs are favored by both novice and experienced investors as they promote financial discipline, allow for gradual entry into the market, and can be tailored to various financial goals, such as wealth accumulation, retirement planning, or achieving specific milestones. Part 2. How do SIPs work? Now that we understand what an SIP is, let's dive into how SIPs work. Imagine you're setting up an SIP with a mutual fund. You decide to invest, let's say, 100 rupees every month. The mutual fund company will then allocate units of the fund to you based on the current net asset value, NAV. When the NAV is higher, you'll get fewer units, and when it's lower, you'll receive more units. Over time, these units accumulate, and your investment grows. The magic of compounding comes into play here. With each SIP installment, you're buying units at different NAVs, resulting in a phenomenon known as rupee cost averaging. This helps mitigate the impact of market volatility and can potentially lead to a lower average cost per unit over the long term. Part 3. How is the return generated through SIP? Now, let's tackle a key question. How are returns generated through SIPs? SIP returns are a result of two main factors: the performance of the underlying mutual fund and the power of compounding. Firstly, the performance of the mutual fund is driven by the performance of the assets it holds, such as stocks and bonds. If the fund's portfolio performs well, the NAV increases, leading to potential capital appreciation of your invested amount. Secondly, compounding is a magical force in the world of finance. As your invested amount grows over time, the returns generated also start earning returns. This snowball effect can significantly boost your overall returns, especially if you stay invested for the long term. Part 4. SIP versus lump sum. It's time to tackle a common debate: SIPs versus lump sum investments. Both approaches have their merits, and the choice depends on your individual circumstances and financial goals. SIPs provide the advantage of rupee cost averaging, reducing the impact of market fluctuations on your investment. They also offer the convenience of regular investments, making it easier to stick to your investment plan. On the other hand, lump sum investments involve investing a substantial amount all at once. This approach can be beneficial if you believe the market is poised for significant growth, as you potentially capitalize on immediate gains. However, timing the market perfectly is a challenge, and lump sum investments can be riskier, especially during market downturns. SIPs, with their disciplined and gradual investment approach, can help manage this risk. Part 5. Real-world examples and case studies. To further illustrate the concepts we've discussed, let's take a look at some real-world examples and case studies. We'll explore scenarios involving SIPs and lump sum investments, considering various market conditions and investment horizons. Case Study 1. Individual wealth building. John, a young professional, decides to start investing in mutual funds through SIPs to build wealth over time. He sets up a SIP with a consistent monthly contribution and selects a diversified equity fund. Over the next decade, despite market fluctuations, John's SIP allows him to buy more units when prices are low and fewer units when prices are high. This strategy, known as rupee cost averaging, helps him reduce the impact of market volatility. By the end of the period, John's disciplined approach has resulted in a substantial portfolio growth, allowing him to achieve his financial goals. Case Study 2. Education Fund Planning. Sarah and Mark, parents of a young child, are concerned about funding their child's higher education. They opt for a SIP-based investment approach. They start a SIP in an education-oriented mutual fund and commit to regular contributions. As their child grows older, they adjust their investment amounts to align with increasing education costs. By the time their child is ready for college, the SIP has grown significantly, providing Sarah and Mark with the necessary funds to cover tuition fees and other expenses. Case Study 3. Retirement Planning. David, a middle-aged professional, realizes the importance of retirement planning. He starts a SIP in a balanced fund that provides a mix of equities and debt. David consistently contributes to his SIP, taking advantage of the power of compounding. Over the years, his SIP grows steadily, and he reinvests the dividends to further boost his returns. When he retires, David has a substantial corpus that helps him maintain a comfortable lifestyle during his golden years. Part 6. Tips for Successful SIP Investing. As we near the end of our video, here are some valuable tips for successful SIP investing. Set clear goals. Define your financial objectives and time horizon for investing. This will guide your SIP strategy. Choose the right funds. Research and select mutual funds that align with your risk tolerance and investment goals. Stay consistent. Stick to your SIP schedule even during market fluctuations. Consistency is key to reaping the benefits of rupee cost averaging. Review and adjust. Periodically assess your investments to ensure they're on track to meet your goals. Make adjustments if necessary. Conclusion. And there you have it, a comprehensive guide to systematic investment plans, SIPs. We've covered what SIPs are, how they work, how returns are generated, and even compared SIPs to lump sum investments. Remember, there's no one-size-fits-all answer when it comes to investing. Your choice between SIPs and lump sum should be based on your unique financial situation and goals. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more insightful content. As always, do your research, seek professional advice if needed, and happy investing. Thank you for watching, and until next time, stay financially savvy. Disclaimer. This video is for informational purposes only and should not be considered as financial advice. Always consult with